Let's now bring in Meghan Shue. She's a CNBC contributor, head of investment strategy as well with the Wilmington Trust. Also with us tonight are fast money traders Tim Seymour, the CIO of Seymour Asset Management, Guy Adami. All of you recognize him, of course. Meghan, I'll go to you first. All right, so we've started the week on a down note. Now what? Where do we go from here?
Well, we are cautious on the market. We're actually sellers of risk today. I think we've seen some mixed sentiment from different analysts on Wall Street suggesting that maybe the bottom's in, maybe you should be buyers of dips. And I know you covered some of that on the network today. I think all of that can at the same time that the market can be pricing in quite a bit of optimism. It can be overbought and expensive. So as we see it, based on our analysis, the market seems to be pricing in a V-shaped recovery. And we just don't think that that's realistic at this time, as much as I would love for it to be. And based on where we see the market trading right now and the expectation that earnings estimates are going to be coming down further over the next few months, we see the market as pretty rich. And so we are modestly underweight equities. At the same time, I wouldn't get too bearish because of some of the positive developments that you covered regarding therapeutics. That will do quite a bit to aid in the recovery of the economy, hopefully in the second half of the year.
Unless, Tim, the market is simply pricing in the overwhelming response that we've gotten from the government and from the Federal Reserve.
Yeah, well, it has been that, Scott. And if you think about how quickly in sequence this came, in other words, in advance of really a recession, that's part of the recovery. I think, Friday's Fed move in terms of really backstopping a lot of the fallen angels and the downgraded high grade into junk is very important, certainly from a market sentiment perspective. But look, I have been one that has said I don't think we have to necessarily retest the 2008, 2009 analog. I don't think has to hold here. Having said that, this is going to be a process that you just talked about with Dr. Gottlieb is going to continue to play out, and the expectation that we go back to work is impossible. So earnings season is going to tell you a little bit about the timeline to at least begin to assess normalized earnings. But that even tomorrow and through the end of the week with the banks, you're only going to get some insight into credit that's going to be the bit of a nutshell, I guess.
I feel like this could be the most irrelevant earnings season maybe in the history of earnings. Guy Adami, I turn to you. Meghan mentioned some of these price targets going up on Wall Street today. You had a plethora of notes, 3,000, a couple of targets there, and then one firm even saying 3,600 by year end because in part of what the Federal Reserve and the government have done and obviously what the virus numbers seem to look like now.
So if you break it down, Scott, and it's great to be with you, I mean, I don't know how you can get to 3,600. I'll say this. When the S&P 500 made an all-time high seemingly just a few months ago, I think it was 3,393. If you assume that S&P 500 earnings were going to be 160-ish, you're talking about a market that was trading at 21.5 times. That, to me, was expensive. The market's basically fallen 20%. You take 20% off the 160, you get $130 and you're at the same multiple. I don't know how you can get to 130. So, yes, earnings probably don't matter, but I'm hard-pressed to come up with a realization or a scenario where we're back to any semblance of normalcy in the next 6 to 9 months. I think the consumer, as much as the president and administration wants to say there's this pent-up demand, and maybe they're right, quite frankly, I think people have learned to live with more for the wrong reasons. And I think, people are going to be very apprehensive over the next year or so to do things that they've done historically. So to think that the market can just ratchet back to 3,600 magically, I just don't see it happening, Scott.
Tim Seymour, Lee Cooperman told me today he doesn't see normalized earnings for 2 years. 2 years.
Yeah. Well, I think that's fair. So talk about the banks, for example. I think we're going to probably see, and if you look at the analysts on the street, it's somewhere by 2022 we get back to 2019. So that's the context in which you want to look at a lot of these companies. And again, in terms of earnings, the things that are most important, the things that I would be watching, have everything to do with accounts receivable, accounts payables, debt covenants. Where's debt to equity? Where have these companies drawn down on credit revolvers? These are things that I think you have to watch over the next couple quarters. And this quarter, no question, and companies should be reeling in whatever liquidity they have.